Greetings, members one and all of the Salivation Nation. Silver outperforming gold. That's the subject of today's video, and it's an opinion piece from silverseek.com written by Adam Hamilton. And we're going to kind of explore, because I think there's some good back information in this article, but we'll kind of take a look through it and see what his opinion is and see if it stacks up. But before we get into that, let's take a look at the silver to gold ratio charts from the past 5 years. Quite interesting indeed. We've seen the markets move between gold and silver, and to me, this is a good measure of silver's performance for sure compared to gold. And we can see that at its lows in the past 5 years, it's been about 60 to 1. And to me, that seems to be a sort of a point where a lot of us kind of agree that's kind of where the normalcy would probably end up being, based off of silver's use as a commodity and an industrial metal and the like, as well as being money. But nonetheless, you know, we've seen it gotten into some pretty big highs. Back in 2016, we saw it go to 83 to 1, and we've seen that record broken, and when it went well over just this past month to 86 to 1. And it started kind of creeping back down a little bit. But can one, at this point, make the case that it is outperforming gold? Well, let's see what Adam has to say here. Silver recently started outperforming gold again, a watershed event. For long years, this white metal has mostly lagged behind the yellow one, relentlessly battering silver sentiment. But gold, surging into year-end 2018, finally sparked some life into moribund silver. This is a bullish sign, as silver has soared in the past once rising prices reach critical mass and attracting new investment capital. Silver looks to be nearing that point again. Despite the good finish, 2018 was a rough year for silver. Its price slumped 8.6%, way worse than gold's negative 1.6% performance, and that still masks miserable intra-year action. At worst, in mid-November, silver has plunged 17.3% year-to-date. That was 2.2 times gold's comparable loss. And at $13.99, silver languished at a major 2.8-year low. The soul-crushing 96% of its early 2016 bull market had been reversed and lost. Back in December 2015, silver had bottomed for a few days before gold at a deep 6.5-year secular low. Over the next 7.6 months, silver soared 50.2% higher, outpacing gold's parallel new bull upleg by 1.7%. That promising start didn't pan out, though. Silver crumbled once gold's advance stalled and failed. Ever since its August 2016 peak of $20.56, silver mostly ground sideways, sandwiched between two major down legs. It was the latter one that finally bottomed in November 2018, with hope lost in silver bearishness universal and suffocating. Silver's fortunes are heavily dependent on gold, and silver effectively acts like a gold sentiment gauge. The weak silver prices reflected the lack of enthusiasm for gold, which wasn't far above its own 19.3-month low in mid-August. Gold had slumped to $1,200 and threatened to break below. For better or worse, gold drives silver. Traders usually ignore the tiny silver market until gold has rallied long enough and high enough to convince them its upside momentum is sustainable. So when gold itself is down in the dumps, silver doesn't have a prayer. But gold bottomed that day and started clawing back higher. So silver joined along in the bounce. That gradually grew into a new silver upleg over the next 8 weeks. By early January, silver had rallied 12.4% on a 7.7% gold rally. And that's January of this year. That made for 1.6 times upside leverage to gold, which is still low on the low side historically. But it was a welcome change after silver spent much of last year sliding considerably. A sub-span of that advance really caught the author's attention between the hawkish FOMC meeting on December 19th to the young new year on January 3rd, silver surged 7.9% in 9 trading days. That was 1.9 times gold's 4.2% advance. So I guess you see that the percentage increase. That is certainly one way to look at it, and by that measure, it would make sense that is an outperformance for that period of time. Silver's best performance relative to gold since the major up leg in the first half of 2016. Something was changing in the left-for-dead silver market. With capital starting to return after more than a couple of years of self-imposed exile, over the past week, silver enjoyed another solid stretch of outperformance, offering further confirmation. Started last Friday when gold itself soared 1.7%. Gold ignited after a Wall Street Journal article claiming the Fed was considering ending its quantitative tightening early. That dovishness hit the U.S. dollar and catapulted gold higher. Over the next 4 trading days, silver surged 4.8% on gold's 3% for a 1.6 times leverage. If that buying can push silver high enough to reach a psychological critical mass and become self-feeding, it portends major silver upside in the coming months. I don't know that I agree with that per se. And I think part of that reason is because of these charts, and we see some of this downside action here with the gold to silver ratio. Look here. Look at that downside action here when it tightened up, and then it went up again, down, and it's been climbing very slowly. But these downtrends here don't necessarily mean it's going to continue that slide. And that's when you're getting into trend and chart analysis, because one can make an argument that this downtrend here looks relatively similar to this one here, but it's been we're looking at record highs between the gold to silver ratio here. I won't really get too much excited about outperformance, although you make base off of measurements for a period of time. Yeah, silver can outperform gold, and you can make the argument in another period of time that gold has outperformed silver. But once it starts to creep below 75, to me that seems to be a level to watch. Look here at this resistance here from the end of 2017 coming into, or from the last half of 2017. It broke that resistance, if there is such a thing, in measuring the gold to silver ratio. But nonetheless, the article continues. The more silver rallies, the more speculators and investors will want to buy it. The more capital they push into silver, the faster it will ascend. Buying begets buying in silver, just like almost everywhere else in the markets. While upside momentum itself is bullish anytime, silver's upside potential is far greater than usual because it's been so darn undervalued. That's made room for massive mean reversion gains. And that's true to a point, and I guess that could be reflected in as far as, especially as a commodity, but a lot of that demand will be driven by where the economy goes this year. Because if the economy slows down, well, what's going to happen with silver's demand? If there's less demand, that means there's going to be less interest in it, which means that the ETFs could suffer because of it. So we could see the gold to silver ratio and silver underperform for a lot of the same reasons. It's quite an interesting time here. Silver's valuation can be inferred relative to gold, its dominant driver. While the global silver and gold supply and demand profiles are independent with little direct linkage, these precious metals are joined at the hip psychologically. And I agree with that to a point, yes. Silver rarely rallies materially unless gold leads the way. And, the author does make a good point about that, and I do think that silver does ride the coattails of gold in that effect. But we're seeing something quite different, especially since since the financial crisis. Silver has become become much more versatile. I think even since then, in electronics and where it's going in the future, and the solar revolution, so to speak, there's a lot more silver being used in that way. So it's being treated more as a commodity. And I think that's why you've seen some of that ratio hit where it is and why we won't see it go back to where it had been before. He says silver traders look to gold for cues, which makes silver amplifying gold's moves. Silver's technical relationship to gold is ironclad. And that's where I disagree with the author because of what I just said. He says all of this makes the silver to gold ratio the more important fundamental measure for silver price levels. And I agree with that. It's technically calculated by dividing daily silver closes by the daily gold closes. But this yields tiny decimals that are hard to parse mentally, like the midweek silver to gold ratio of 0.012 times. It's far more brain-friendly to consider this ratio from the opposite direction via the gold to silver ratio, or the gold, so I guess when you look at it from the other perspective, the silver to gold ratio as opposed to gold to silver ratio, the week it ran and easier to comprehend, 82.2. That's 82.2 ounces of silver for every ounce of gold. Mathematically, the silver to gold ratio is identical to an inverted GSR. So charting the GSR with an upside down scale yields the same line as SGR, but with way more intelligible numbers. Here, the inverted GSR SGR proxy in blue is superposed with the silver price in red. Silver has rarely been lower relative to gold than it was in recent months. That portends monster upside in silver means reverts to higher leaning gold. In this chart, I studied it a little bit, and it's still kind of hard to comprehend here. There's the 85, 80, this is the number of ounces of silver per ounce of gold, and the price. And so we're back here. I guess that's what that blue is, and there's a price of silver. It's kind of hard to make out. I don't know that I'm going to really go with that, but at the latest secular silver and mid-low, the SGR fell to 85.9. In other words, it took nearly 86 ounces of silver to equal the value of 1 ounce of gold. While silver started recovering, it initially lagged gold enough to force the SGR still lower. At the end of November, it slumped to a low of 86.3 times at close, an astounding level. That was actually an extreme 23.8 year secular low in the SGR, nearly a quarter century. Silver hadn't been lower relative to gold since March 1995, practically a lifetime ago, considering all that's happened in the financial markets since. Even during the greatest market fear in our lifetimes, the SGR wasn't lower. During late 2008's first-in-a-century stock panic, the SGR just briefly hit 84.1 in mid-October. Being highly speculative and super sensitive to sentiment, silver had plummeted leading into it. And that's just it. Silver is much more volatile in that regard. So it is a safe haven against economic instability, but gold is the safest safe haven, in my opinion. The stock panic episode of extreme SGR low shows what's probable after silver inevitably reverses and means reverts higher. Over the 3.7 years since 2005 leading to that panic, the silver to gold ratio averaged 54.9 to 1. That was right in line with the mid-50s that had been normal for decades. Silver had generally oscillated around 1/55th the price of gold, so miners had long used 55 times as the proxy for calculating silver equivalent ounces. With silver so radically out of whack relative to gold, those extreme SGR panic lows weren't sustainable. Like a beach ball pushed too far into water, silver is ready to explode higher to reestablish its normal relationship with gold. Although you can't use that measure anymore, that average of the 55, in my opinion, nowadays. After the crisis, I think silver changed dynamically, not just because of the way that things were with relations to our economy and the new economy that kind of reemerged from that crisis, but literally and physically, the usage of silver has become more versatile since then. And also, less photography was used, and it shifted in its uses and gains. The indeed happened during the past post-panic years. After plummeting as low as $8.92 in late November of 2008, silver more than doubled by early December of 2009 with a 115.4% gain. While silver was really outperforming gold after this anomalous lows, at best, the initial post-panic rally, the SGR only regained 58.6 times. That was still below the 55 times secular average. So silver continued slowly grinding higher on balance until late 2010. The gold started surging again, created the right sentiment, conditions to unleash the self-feeding silver buying. Silver skyrocketed from there, surging far faster than gold. You know, and that could happen again. And in 2011, he posted another example. The faster silver soared in early 2011, the more traders wanted to own it. The more capital they poured into it. I remember those times. It was quite a rush and bull to silver. And I even partook into it, but it was an anomaly. The psychological phenomenon of higher prices being more attractive runs through nearly all markets. People tend to buy high and sell low. The crazy Bitcoin mania in the late 2017 was a recent example of this, and boy, he's the author's right there. Silver's virtuous circle of surging and new capital inflow has finally climaxed in late April 2011, of $48.43 an ounce. That was one heck of a bull. It was an anomaly for sure. And the article kind of continues on here, but I think we've got the gist here of what's going on. It's a very intricate and in-depth article, but really, the key is we could have another. With silver, there was two big bull markets, both anomalies for different reasons. You had the 1980 Hunt Brothers, and then you had the 2011 anomaly with what had happened there. And I actually had posted a video about explaining the difference between the two, so I won't go into that. But nonetheless, both were anomalies. They were not the norm. Silver could continue to outperform gold, and it's likely that you will see a case like that occur in short bursts and quick radical moves because silver's volatile, which means it can be volatile to the upside just as it can be volatile to the downside, which is why you see a lot of this stuff. If you take a look at the 10-year silver to gold ratio chart, you can see there. Look at that. There's 2011. During these spikes, you're going to see a tightening of the gold to silver ratio. And if you look at it for an all-time gold to silver here, you can see those spikes. Look here. In 1980, it came down to its mining, closest to its mining ratio. You didn't have that since anything close to that since back in 1970. And then, you're seeing what's happening here in 2011, that tightening to where it got down to 38 to 1. It was only right after the financial the dot-com bubble kind of bursting here in 98. You've had it tighten down a bit here. But nonetheless, there it is. And now that gold to silver ratio, you can take advantage of that gold to silver ratio in the ETF and paper markets. And there's a book that explains how to do that. You've heard me mention it multiple times, and that is the book Trade the Ratio by Carl Ushanka. And it's now been released in its second edition, and it's available at Amazon if you're interested. But Carl definitely outlines ways to be able to take advantage of it using those markets, and has better other examples and things in it. Even has a portion inside of there about collectible coins and like from Losing Louie. So pretty interesting and fascinating that Carl has used members of the community and their perspective in his writings. I wrote a small review of it in the back of his first edition. But for those interested in being able to use gold and silver to your advantage, in a way, using them kind of in your investment portfolios, this is one way to do it, to bet on the gold to silver ratio and make trades with in relation to it. So there you go, but fascinating indeed. So silver is outperforming gold. Yeah, it is for now, but who knows what will happen. Because I'll just recap. Silver is a safe haven. It is a safe haven. It is a hedge against economic instability. I agree with that for sure. I think it's money. But I also think that it is more volatile than gold. So gold, it's the safest of the safe havens. There you go. Post your thoughts below. I'd like to extend a multitude of gratitude to y'all for watching, and encourage you to please rate, comment, and subscribe.